Hi there, very good afternoon, good evening. Welcome to this edition of Get Rich with CNBC TV 18. I'm your host, Nigel D'Souza, and with me today, we have Gurmeet Chadha, who's come down from Delhi. Well, Gurmeet, good to have you in the studio. And as we were just discussing, I just want to tell all our audience as well out there, every time Gurmeet comes to Bombay, we have a bit of a rally, and today was no different. Fantastic move on the Nifty. Where are we headed out there?
So it's always good to be in Bombay. I think I think I have a good, pleasant memories of coming here. Every time meeting clients, seeing markets go up. I think the market should consolidate. I think the valuations look fairly expensive now, right. And this is not 2004, 2009 or 14. When after getting a decisive mandate, the valuations are much cheaper. Right. So I think the focus has to shift back to fundamentals. I think we still have issues with terms of NBFCs unable to refinance debt. The earnings are patchy. There are consumption slowdown issues. I'm also worried on yuan being 7 to a dollar. Yeah, so that is so I think there could be some disruption, but overall things look good. Any correction, any dips should be bought into. So this is a buy on dips market, not a sell on high. And there are pockets of opportunity. Also, I think the fixed income space also is looking very exciting. Okay. So if one is more prudent right now in terms of being equal weight or giving as much importance, because India has the highest real rates, which is at about 3.5–4%. World over, you have negative real rates. True. Right. And I think you will see a second half of the year a synchronized monetary easing and stimulus by central bankers across the world. Okay, so,
let's focus on the Nifty. You said that this is a buy on dips market, but on the headline index, have we done that run? Do you believe that 12,000, 12,100, maybe 12,500? Have we done that run? What's your view on the index? And also, we've been relative outperformers, isn't it, in the month of May?
Yeah. So I think India is up around almost 2. If you add today, probably you're up 3% versus MSCI World Index down 6%. Right. The emerging market index is almost 8% down. I think, there's a feeling of since I handle a lot of family office HNI portfolios, there's also a feeling of, are we staying on the sidelines for too long? Right. So my sense is that some momentum can be sustained, let's say on an immediate basis. We're very difficult to comment on that. But I think some consolidation is due, and that will be good for markets, because if you at an Nifty EPS of today, 141, you're almost touching trailing 30 times, which is too high and not sustainable once if the earnings don't catch up. So some bit of consolidation is due and would be healthy actually.
Okay, sustainability is par for the course, as Gurmeet says. If you just consider that the Nifty EPS is going to go up by nearly around 20% in the coming year, even then we're trading at nearly around 21 times odd. So if you're working with an EPS of around 600 for the coming year itself. But that's an interesting point you made in terms of even the Chinese currency. Yeah. We have been talking about the US putting tariffs of 10%, 25% on Chinese goods. Well, the Chinese currency has depreciated by nearly around 10% in the last 1 year. And that's a bit of a worry, because when the Chinese currency does depreciate, then they'll send out more amount of their produce, and that could hit markets like India and hit India destinations as well in terms of steel and other products as well. All right, so we've got our view in terms of the index. Consolidation, not so bad at current levels. But what are the sectors you like? I was looking at some of your views in the past. You've liked cement, you've liked private banks. You want to name a couple of stocks out there?
So in cement, we like more, so there are a couple of pan-India plays like Ultratech and ACC. If you see in Nigel, about 7 years back, you had top 5 players with 35% market share. Okay. And today you have Ultratech with 150 million tons being almost 1/3 the market. Right. Right. And they've coupled that with price hikes, couple that with raw material prices being benign, couple that with the lot of work which has gone in power and fuel efficiency, which will increase the EBITDA per ton. Right. Interestingly, I started my career with a cement company, which is ACC. ACC, straight from the campus. So I think what also we are seeing is with GST, you will see, because cement is on a cost to delivery basis, even the freight costs have come down. With the load going up, and I think so Ultratech looks to be a very, very good play. I like Shree Cement. I think if you notice, it's around a 40 million ton kind of a player. But they have done high frequency, low magnitude additions, which means they cater to the geography demand. The turnaround time is quite quick. They have a 640 megawatts of power plant. The waste heat recovery management is state of the art. So very good product. So these are the two picks there. Down south, maybe you can look at Dalmia and maybe a Ramco, courtesy the price hikes which have happened. Dalmia was about 50% operating capacity till about a couple of years back. And I think they will get some operating leverage. And in banks, like private banks, in fact, I was just doing a check that, ICICI Bank 5 years back at 3.5 lakh crore loan book had a 2,700 crore PAT. Today, your loan book is 6.5 lakh crores. So, once 2 or 3 quarters, if they can control the credit cost, get the ROE back at 15%, and so at 1.2 lakh crore market cap, 15% ROE would be 18,000 crores of PAT.
Yeah.
So I think ICICI Axis, Axis more for the long term. A great fan of Amitabh. So I think these are the few scripts one can look at.
Okay, and in terms of banking names, both these two, Axis Bank and ICICI Bank, a couple of years back, everyone said, hey, let's stick with the best. But if you put your money in both these two, you've got a good move. Axis Bank more than 800 rupees, ICICI Bank at more than 400 rupees. And to be fair, the market was being a little, very strict with both these two banks, giving them a multiple of maybe 1.5, 1.8 times odd. That has expanded as well. So from the banking space, Gurmeet tells us that he's quite positive on Axis Bank as well as ICICI Bank. From the cement pack, Ultratech Cement and Shree Cement, that meets the cut. And if we're looking down south, then maybe a Dalmia Cement as well as Ramco, both those two companies is what Gurmeet likes. But another problem is in terms of these NBFC stocks. Some of them, that's a problem pocket actually. Every time you see the market get into a bit of a tizzy, it's one of those NBFCs that have gone wrong. Do you like anything from there?
So I think once with good parentage, and I think you have to look at the liability side to pick up an NBFC. So if, for example, look at Mahindra and Mahindra Financial Services, I think it's a 61,000 crore asset book, very well diversified across commercial vehicles, SMEs, vehicle loans, housing finance. The cost of funds has only marginally gone up. They have presence across, and their liability side is extremely powerful. Good tier 1 ratios. So, I think that can do, very well. Bajaj, to me, I always say, and I've been saying this to others also, that Bajaj Finance is a consumption stock. At that kind of balance sheet, they're still talking about 25% balance sheet growth. 20-25% growth in net interest income, and AUM's growing at 30-40%.
Class apart.
Yeah, class apart. I think the ones with better, even Tata Capital, so ones with better parentage, better liability mix, more retail, more granular approach will stand out. Housing finance companies will have a tough time, especially with high exposure to developer loans. I think there are more skeletons which will come out, and NHB is a very soft regulator, Nigel. I mean, they're not as stringent as what RBI is. So once you'll see the change in norms, we already have there talks of liquidity coverage ratios for NBFCs. I think a lot more will come out. So, but I think the men will get differentiated from boys.
All right. So in terms of NBFCs, be very, very select in terms of what you're going out. Select those companies which have good parentage, very, very important. Mahindra and Mahindra Financial, that's one of those companies that Gurmeet likes. And the other one he's referring to is the Bajaj twins. Remember, they were expensive at around 4 times. Then they went around 4.5 times price to book. And then even at 5 times price to book. So Gurmeet, the short point he's making is stick to quality and you'll make some good money as well. Let's get in a couple of queries then. We have quite a few of them that are coming in there. We have Venkateshwaran who says, hey, Nigel and Gurmeet, thanks so much for hosting the show. Well, we're happy to host it. We are looking forward to answering some of your queries. Vimal is asking us, what about TCS? Can it be bought at these levels? And what's your view on the IT in the farmer pack? I remember maybe a decade or so ago in 2008, IT was something that people really liked. Today, not so much because there are other sectors. What's your view in terms of Vimal's query on TCS as well as the IT pack?
So hold for me. I mean, I think it will be very steady. If you break it vertical wise, I think BFSI is showing signs of growing, which is their largest, which is a third of the revenue. The digital business is now also almost contributing 30% of the revenues. On-site margins are a bit of a headwind. FX movement also will impact. So every 1%, change in rupee dollar equation, there's a 30 bips impact. Both ways, even for large treasuries with sophisticated, hedging skills. Attrition has been a bit of a challenge. But in terms of if you take segment-wise growth, I think there is more to. So TCS is more buy and forget. I think just stay steady with it. And another space which looks good in this is Tech Mahindra. It had a soft Q4. But if you see the telecom vertical had a third successive quarter of growth. But the enterprise business was a little weak. My sense is the launch of 5G I think it has the right ingredients to and very reasonably valued, much more reasonable than.
But would you deploy fresh money here, or you're saying that if you've made investments in both these two, hold on to them?
So hold for TCS and maybe buy Tech Mahindra on dips.
Okay, buy Tech Mahindra on dips. I hope that solves your query as well in terms of the query on TCS. Vimal, I hope we helped you out on that one. If you're looking to buy a fresh, then Tech Mahindra could be the one you look at. Somin Das is asking us about JK Tyre. He's got quite a few shares. I'm not sure whether it's 93,000, but he's got JK Tyre in short. And he's also got Motherson Sumi at around 172. That stock as well has seen a sharp correction from there. Yeah, what's your view on this? And good to see at least we have a couple of long-term investors who are writing to us. So Somin is asking us, what's the expected return for the next 5 years? Basic point is, should he be buying these stocks? Should he be holding on to JK Tyre and Motherson Sumi or the auto ancillary space?
So I think tyre makers will be in a bit of a, have challenging times for maybe a couple of quarters. But if he has the ability to hold, he can. See, there are three components to tyre makers. One is the original tyre sales. Second is your replacement. And third is your exports.
Right.
So better pick would be MRF because it's a dominant player in all three segments, and it's still quite a fragmented industry. The top 10 players make up for 90% of the market. Right. So MRF for me, in case you want to have a 5-year outlook.
Okay. In terms of tyre play, you go for MRF.
Right. Motherson Sumi, to me, I think he can start averaging it out. He can buy a little more.
Okay.
If you see, it's the largest wiring harness maker. Started off as a wiring harness supplier to Maruti, and it's come a long way. It's also the second largest in terms of auto rear view mirrors.
Okay.
And also a leading supplier on plastic components for autos. And their strategy is to focus on increased content per vehicle.
Okay.
So it's going through some challenging times because of the global slowdown, high debt levels. But they have a proven track record of turning acquisitions around. Generating good free cash flows as and when things stabilize. So Motherson Sumi to me, and maybe another one could be Minda.
Minda.
Minda Industries one can look at, but be patient. Don't be in a rush to buy. I think the pain would last for some more time and just accumulate over the next 2 to 3 months.
All right. So the advice in terms of Motherson Sumi is that it's a high quality management with good pedigree. They've made some of those acquisitions turn around. So Gurmeet says if you have it at 170, you can look at averaging it at these prices. Remember, ROC of around 40% approximately is what they have maintained as well in the past. So Motherson Sumi is a stock that you could look to average. And the other one, if you're looking at a fresh auto ancillary stock, then Minda Industries. That could be the one that could weather the storm. So keep an eye out on that as well. And maybe you could buy it. But as Gurmeet is telling us, buy it in a staggered manner. Don't go out there. If you have 100 rupees, don't go out there and, allocate all that money. Well, we have another query that's coming in there from Samir Dandekar. He's asking us about two of the large names. One is Ambuja Cements and Infosys. In terms of tech stocks, you've already told us that TCS and Tech Mahindra is something you'd like to buy. What's your view on Infosys? And Ambuja Cements, does it meet the cut, or you rather stick to the bigger names?
It does in a way, but the only challenge we are seeing in the north part of the country where Ambuja is dominant, especially markets like Punjab, Himachal, Delhi. The price hikes have been followed by some rollbacks, right? And they've been struggling in terms of, with some of the dealer network as well, in terms of our first cut. So ACC looks a better play. It's an old player.
Valuation supportive.
Yeah, valuation supportive. So ACC over that looks a better. Anyway, it's part of one large group now. So there, Infosys again. As I said, but to me, it's nothing much separates between Infosys and TCS.
So you rather stick
I'm a little worried on attrition rates in Infosys. They have done out-of-turn promotions in 6-month review. They've changed the review cycle. They're looking at some ESOPs now. So there's a bit of more of a manpower challenge in Infosys right now. So maybe a slight preference to TCS would
okay. Preference to TCS could be, the view that's coming. There are valid points that Gurmeet's making actually. A lot of problems in terms of manpower, a lot of questions being asked out there. So you rather stick with two managements that there are not many questions being asked. TCS is something that meets the cut. Tech Mahindra is the other one that he likes. And in terms of Ambuja Cements, well, he says go with ACC. Whole host of reasons, one of them being that valuation-wise, ACC is relatively cheaper in comparison to Ambuja Cements. So keep an eye out on that one. Well, Thiru is asking us, what about pharma funds? Is there anything that he should be looking at in terms of starting? Maybe I think he's referring to starting a mutual fund or an SIP, or maybe just go out there and buy some pharma stocks.
So SIPs in thematic funds really don't work the way they work in diversified. You have to be more tactical when it comes to thematic. If he really wants to do a thematic fund, probably banking looks to be a better option. And there are a lot of technology funds which have come up now, which is 60% Indian tech companies and 40% maybe NASDAQ ones. Franklin has one. So that's a more long-term play if one has to look at SIP there.
So Franklin has one of those?
Yeah, they have a India technology fund, which is 65% Indian technology stocks and 35% players like Apple, Samsung,
oh, that's interesting.
Alphabets of the world. Yeah.
So Franklin has a play. You'll be playing both the IT, the tech story in India, and as well as the tech story in terms of those FANG stocks as well.
Yeah.
Facebook, Apple, Amazon, Netflix, as well as Google. Yeah.
On pharma stocks, one stock I like, despite expensive valuations, is Divi's Labs. I think it has a steady mix of generics and CRAMS.
Okay.
So generics is 55% of the revenue, and CRAMS is about 45%.
Okay.
I think it's been the first. It's got the first mover advantage in this global outsourcing pharma industry. It has superior chemistry skills, ability to add value in the late life cycle strategies. The relationship with the innovator companies is very, very good. So, it gives you a right mix of steady cash flows and high margins because of CRAMS. So Divi's Labs can be looked into. Dr. Reddy also looks, if you see last 1 year, pharma index is flat. Dr. Reddy is up 35%. So a lot of changes in their India business, focus on China. They have a tie-up with Rotam, which is a 2-decade tie-up.
Right.
There's an anti-blood clotting drug which is opening up now. It's a $1.6 billion market.
So you're saying that Divi's Laboratory, the last quarter's numbers weren't too great, but you believe that on these sort of dips, you should look to, allocate some money to Divi's Laboratory. And also you're saying that in the last 1 year, Dr. Reddy's has been the big outperformer. So allocate some money over there as well. Okay, those are the two pharma picks then in terms of what Gurmeet has to say in the pharma space. We have a few queries that are coming in there. Josh Shah is asking us about Ujjivan. If you have a view out there. And also we have Manish who's asking us, about some NBFCs. Gurmeet already told us he likes Mahindra and Mahindra as well as the Bajaj twins. He rather stick to quality out, yeah. But let's try to address this query on Ujjivan. Gurmeet, what do you have to say out there?
So if you have to bet on the management, Ujjivan is a very interesting model with MFIs and some of the rural and SME facing interface on the credit side.
Right.
So Nitin Chugh has joined, he's the one who built up HDFC in terms of the retail book, the credit card division. Right. And then you have Mr. Bansal now becoming a director there. Right. So there's something in it which probably the veterans are seeing in terms of turnaround. So one could look at it. Looks too little expensive to me. Okay. Maybe wait for some correction, and it's more a question of how strong faith you have on Ujjivan. So if I was to given a choice, I would still prefer private banks from a near-term perspective, right? And maybe Ujjivan from a 4 to 5 year perspective, a small portion, because the upside there could be quite huge.
So from a longer term time horizon, you'll say that buy some Ujjivan right now. But otherwise, you would prefer the ICICI banks and the Axis banks.
More from a near-term perspective.
Okay, all right. Then longer term, not too bad to put in some money in terms of Ujjivan. That's Gurmeet's view as well. Well, Samir wants to make it a little interesting. He's saying, what's the view on oil companies as well as aviation stocks? Gurmeet, you're flown in here this morning. You're going to be leaving back to Delhi later tonight. But would you just stick to the flying and say, let the investing in stocks, let someone else do that? I'd rather just use their services. Or do you believe that in terms of aviation stocks, you should put some money out there? And oil companies as well, I guess he's referring to
the OMCs.
OMCs, yeah.
See, aviation, I think one could be a little tactical in terms of getting into maybe, Indigo.
Okay.
Right, reason being there have been some concern on, promoters having some kind of a disconnect in the way things are. Right. But, better way to play an air travel story in India and this consumption play is hotels and something like VIP. Okay. And if you see the hotels now, the occupancy rates after 2008 have picked up by 3%. Right. You have something like an Indian hotel which is not moved for last 3-4 years. And the new guy there is talking of a very asset-light model. Right. They've signed up 6 hotels this year. GIC is investing 3,000 to 4,000 crores to pick up more. So, so they have abandoned the mono brand strategy as far as the Taj is concerned. Okay. All right. So Indian hotels look very, very good. Even Oberoi, the EID, that also looks quite interesting. Okay. VIP again, excellent franchise. The demand for hatchbacks, the overall, formalization of economy, GST benefits, strong retail reach. I think so. Those are, if you want to really play on air passenger growth, travel. Hotels and travel companies make a better.
I mean, you're making perfect sense out there. If airlines are going to be going full and if people are going to be traveling so much, Gurmeet says, hey, instead of playing those aviation stocks, if you must play those aviation stocks, then maybe Interglobe Aviation could be the stock you can be looking at. But otherwise, look at VIP. If someone's going to travel, they require a bag, right? So maybe you could buy VIP. And the other one that Gurmeet is saying, if they're going to be traveling, not everyone will have a house in every part of the country. So maybe you can go ahead and play Indian hotels as well. That's a stock that hasn't moved in the last few years, and they've been moving to an asset-light model. You also have money coming in from a couple of large funds, and that's what's going to help them going ahead as well. And we try to check in over any weekend, particularly in these months. You're not going to get very lucky any which ways. But what about OMCs, oil marketing companies?
So, you know, they were great buy when HPCL was below 200 book value. I think there's been a sharp move. Again, be tactical here. Whenever you see drop in oil prices, your core portfolio should not have OMCs.
Right.
But there is a large correction because of any geopolitical concerns, fresh triggers due to Iran.
Right.
So also in HPCL, if you see, they are also the largest lube-based refinery in terms of lubricants.
Right.
Great marketing infrastructure. And last quarter, the average crude prices, were at about $67, $68.
Yeah.
So the inventory losses weren't there. That's why you saw better set of numbers.
Right.
So when the average price of crude actually goes up towards the month end, and then it makes more sense. And also the marketing margins have slightly gone up, the retail prices have slightly moved up. Plus it didn't tinker a lot with the prices during election.
That was a pleasant.
So too many moving parts, but if you get a massive correction due to geopolitical reasons, just get on to it, have a trading call. Don't have a fundamental.
But as of now, you say stay away. There are better sectors to play. Stay away. There are better sectors to play. That's what Gurmeet's advice is. Well, we have Hussain who's asking us, what about Nalco and Edelweiss with a longer time horizon? Well, Nalco, last year alumina prices had gone through the roof. Things were looking very, very good. You had Elenor Knox Hydro that had a bit of a shutdown. That stock is corrected to around 49 rupees approximately. And Edelweiss is the other stock Hussain wants to know. Track any of these?
Yeah, do track. I think commodities stocks, especially the non-ferrous ones, I think the right trigger would be when you see the next round of QE coming.
Okay.
In case of a global slowdown, in case of China struggling.
Better not to play them?
I mean, commodity prices will be under pressure. But if you want to be tactical, once the quantitative easing starts, when you have a formal announcement coming, then there will be a risk on. I mean, all asset classes will move up. Commodities probably will bounce a little more. So maybe you can use that as a trigger. Again, restricted to the trading side of the portfolio, not fundamental.
So for now, avoid it.
Avoid it.
Any view on Edelweiss?
I think you should start looking at the debt market for any triggers in some of the names like Edelweiss or an IFL Holdings. And so once even right now they are borrowing at 50-60 basis premium to the other AA issuers.
Right. Okay.
I think once the credit issues subside, even at those price points, it would still give you a nice upside. However, it's one of the better managed NBFCs. They are trying to de-risk. They are trying to infuse money.
Yeah.
The capital adequacy ratio is a tad lower than what it should be.
Yeah.
Right. So wait for maybe an RBI policy whether if they give a special line to NBFCs.
Yeah.
And when the yields stabilize, that's when you should start getting into the Edelweiss of the world.
Okay, all right. Then, so plenty of moving parts. For the time being, avoid Edelweiss as well. We have a query that's coming in there from Venkateshwaran. He says, what are your thoughts in terms of the IFL demerger? You're going to have the wealth, securities, financial, all of them separated right now. Have you had a look at that?
Yeah, I did have a look at it, and so I have a lot of friends who are competitors and who work with the IFL. I think their asset management and wealth business is doing very well.
Okay.
Their broking business is also very, very steady. I think where they are facing concerns is the home finance. Their bit. So my sense is just wait for a little more time. Let things subside. That's what I said for Edelweiss.
Yeah.
But they are now the largest asset managers. They're actually ahead of Kotak Wealth, which used to be the largest player in the wealth management space.
Okay.
That business looks very, very exciting.
So wealth part of
because the financialization of savings is here to stay.
Okay.
And they have a great team, very good product team as well.
Okay.
So that part of the business looks very, very promising.
Okay. So for the time being, but if you have to buy one part of the business, then the IFL wealth business.
The wealth business is what is a long-term buy.
Okay. So that's the IFL wealth business is the one that you should be looking to get yourself into, because that could be a long-term wealth creator for you as well. But today the big focus really was on the auto space. The Nifty saw a big rally over the weekend. I only kept hearing about X missed their estimates, Y missed their estimates, Maruti's was at multi-month low, etc. And in fact, today the auto index was the best performer. It was up nearly around 2% by the time we wound down. We have a couple of queries that are coming there in terms of the auto space. We had a query on Tata Motors as well. So what's your view in terms of Tata Motors? The domestic piece was looking good. Now you had a bit of a slowdown in the month of May. and the global piece is not looking very, very good. And besides that, what's the auto view on the whole? Do you like some of these two-wheeler names, Bajaj Auto, for example? Yep. Quite a pleasant surprise coming in from there.
So Tata Motors has been a bit of an enigma. You had a few years back the JLR doing well, domestic not doing well. Now you have the domestic doing well, JLR not doing well. You know, I would wait for the China numbers to stabilize. I think that's where the bulk of the valuation.
So don't look at Tata Motors for now.
No, don't look at.
What else would you look at?
So this is not a market to be very, very you know, experimental and adventurous with. You know, so one can look at Bajaj Auto, as you rightly said. If you break down the numbers, you know, they are talking of 1 lakh units per month for Pulsar. Okay. Which I think is a huge number, considering that they started the year with 14% market share, and they will probably have ended the year at 23-24%. So that's a gain of 8-9% market share, obviously at the cost of some margins. They're talking of an electric two-wheeler on that platform. Three-wheelers was a tad soft, but this month also their volumes grew 6-7%. Okay. Exports, the kind of work they have done, Nigel, I think the others will take 4 years even if they were to start right now. The kind of distribution arrangements they have in LATAM and in North America, in countries like Thailand, I think it's spectacular. Also, they are the mid-segment, the middle segment, which is that 40,000 to 48,000 rupees price. That's not doing that well for them, but they're trying to use the KPT technology platform to, you know, to build on that. So for me, promoters have been increasing stake of late. Right, gaining market share. So I think Bajaj Auto looks a very, very compelling buy.
So you'll play the two-wheeler play out there.
Start with Bajaj Auto.
Bajaj Auto, something you like. You already told us in terms of auto ancillaries, you like Minda Industries is a stock you like out there. There was another stock that was in focus today, Mahindra & Mahindra. Promoters interesting going out there and selling 1.5%, where the stock is nearly at a 52-week low. I was quite worried, you know, personally, because everyone's talking about the cycle slowdown, and the promoter goes and sells, but the market seemed to have been prepared for some sort of this news, because the stock recovered as well from the low point of the day. How would you play Mahindra & Mahindra? And just thinking out loud, in the last few quarters, the promoters have been reducing stake. Is there something more going on out there?
It's quite intrigued as well, to be honest, I think. And at this price, selling the treasury selling the stake, and it's not a name where they could probably are looking at a technological tie-up or something. It's a marquee name though. I think we should wait for the management commentary to come in. I think what I'm worried about is their ability to adapt to the BS6 norms. Their KUV 300 model, I think the management has made clear that probably will not be able to adapt to BS6. So, and they have a very high proportion of diesel vehicles. And to shift to that new norms would be a bit of a challenge. But the only savior could be the electric vehicles launch, but the volumes may not build up steadily. The tractor guidance gives me a bit of a confidence because they are still talking of 7-8% growth. I don't, despite bad numbers, you know, on the tractor side. I think the tractor segment could be a bit of a savior. And so you'll have to wait and see. But you know, the downside risk to the stock, Nigel, also is quite. It's in low single-digit multiples. So the
downside is protected as well. I mean, I think very minimal debt. I think book value of maybe 320 rupees, 325 rupees. So would you allocate some money, or would you wait by?
I would just wait for maybe a month or so. Four-wheelers right now, I think one should avoid.
It's
be where the earnings growth are.
I mean, it's a little bit confusing actually right now. What do you do with some of these auto names? But Bajaj Auto is one stock that you like at these levels as well. Well, we have Sachin who's asking us, what about Yes Bank? He's also asking about Jubilant Life Science. Any view on these?
So Yes Bank again to me is an avoid. I think wherever there is a corporate governance issue, I
touch it.
I think the market verdict is also very, very clear. I think the market is also not fully convinced that the credit cost slippage of 200 basis points would be it. I mean, I think there will be more provisioning. I think their exposure to ADAG groups, you know, some of the other names could be in focus in the coming quarters. So and they have a lot of unsecured lending book. They are into project finance. So go with the the granular ones, the CASA oriented ones, better cost of funds.
So avoid this one. Stick to the banks that you have told us: Axis Bank, ICICI Bank. Any view on Jubilant Life Science?
Again, an avoid. I think
avoid Jubilant Life Science.
In general, pharma, barring a few names, one should.
All right, and the stocks that Gurmeet likes is Divi's Laboratory as well as Dr. Reddy, so that should come up for you. Well, Sarang's asking us what's the view on Jyoti Laboratories, and you've asked us quite a few times. Sorry, mate, I'm coming across in terms of Jyoti Laboratories, or maybe in that space if Gurmeet likes something. Gurmeet, any view of that?
So not really related. One space I like is the in the overall specialty chemicals bucket. We like Aarti. Aarti. So if you see, they are more into benzene-based derivatives.
Right.
And the specialty chemicals makes up for 80% revenue and 90% EBITDA.
Okay.
The N1, N2 stage outsourcing is a very dominant theme, both for India and China. India has a better record both in terms of pollution controls and protection of intellectual property rights. And this is a B2B business, very high entry barrier. Doesn't look easy, for a new guy to come and strike a relationship with a UPL, a Dow, may not be very easy. So Aarti looks...
Aarti Industries, okay, that's a stock that we could focus on. Well, slowly we'll start winding down the show, but before we do that, normally on the show, Gurmeet, we ask, all our viewers keep asking us, give us that one stock. You've got a couple of those stocks that you would like to talk about. If someone is building a portfolio, which are the top 2 or 3 stocks that you would recommend be part of their portfolio for the next 18 to 24 months odd?
So one space I like is the agrochemical space. I think post the Arista acquisition, UPL is looking at a $5 billion kind of a top line and $1 billion kind of an EBITDA. This is, pre-synergy, whatever works out. And if you see India, the penetration is quite low as far as agrochemical space is concerned. LATAM constitutes about 35% for UPL. And if you take last 4 years, that market has been growing at 16 to 18%. So I think that looks very good. 3 billion worth of products are going off patent. UPL has almost 6,200 registrations and has a great innovation rate. In fact, last year, the innovation rate is up from 14% to 19%. Right. They've got some 270 registrations done in last year itself. Herbicides make up for about 33% of the revenues for them, which is far more revenue accretive than some of the other products in that space. So that looks very, very good from a long-term basis. Very good business at an ROC of 24-25%. I think they will be able to fund the debt will also come down as the free cash flows increase.
So you're confident on the stock even at 1,000 rupees. In fact, in talking about that acquisition, when everyone was worried about the acquisition, the stock corrected to 600 rupees. And guess what? Post the acquisition, the stock at around 1,000 rupees odd. So that goes to show that in hindsight, that dip was something that you could have bought from. So from the agrochemical space, let's get that up for you on the screen. Gurmeet says that UPL is something he likes. He's already told us in the banking space, he likes ICICI Bank and Axis Bank. And you like to play the consumption theme? If yes, how would you play it?
So one niche theme which I like is the multiplex operators. They've been under a lot of news, especially with this OTT, discussion of players like Amazon and Netflix of the world taking over. I think it's the same case like Swiggy's and the restaurant. I think one is a binge watching service, other is a family experience. So I think this space will evolve. So I like PVR. If you see, there is a lot of massive consolidation happening. PVR picked up SFI down south. Inox picked up Satyam. Cinepolis picked up Fun Cinema. So a lot of consolidation happening. You're probably not talking of 2 to 3 players being 50% of the market. There are still more than 6,000 single screens which will get converted into the multiplex themes. The penetration is about 8 per million, which is I think pathetically low as far as if you compare it to even countries which are emerging economies. Also, there's a lot of tech disruption there. There are a lot of new customers, different customer formats. You have direct to cart, you have a gold class. For kids now, they're talking of Playhouse. So there's a lot of different customer viewing formats coming up, which will aid the numbers. The Hindi box office collection this year could be 15,000 crores. The concern on that Maharashtra ruling on F&B
that's behind.
Yeah, that's behind. It's going very well.
PVR went to around 1,100 and from there it's at around 16, 17, 1,800. So all those opportunities are buying opportunities.
Both are good. Both PVR and Inox are good. I think, and they will deleverage. The debt levels will come down, so that will add. And another second is the home improvement theme. I think the housing will see a big revival now with a push from the government. So anything in that space which is, players like Havells, which are into all, they are into switch gears, they are into lighting.
The wires will not catch fire.
Not catch fire. Something like a TTK Prestige.
So a few stocks that Gurmeet has, recommended to all our viewers out there. If you're looking to build a portfolio, look at banking names. Axis Bank, ICICI Bank. If you're looking at the, the home building space, then maybe Havells is something that comes on your radar. And if you're looking at the consumption theme, then PVR is a stock that you could look to buy. And finally, from the agrochemicals space, UPL is a stock that could have various tailwinds for it going ahead. as well. Well, we'll wind down with a couple of final queries then. Ashok's asking us, what about two-wheeler stocks? Well, Ashok, I don't know whether you've just tuned in, but Gurmeet likes Bajaj Auto as well. Lalit is asking us, what about Yes Bank? Gurmeet says, complete avoid. Don't get into Yes Bank. And I think we had a couple of other queries on Natco Pharma. Indukuri, well, Gurmeet has already given us his takes in terms of the pharma space. That's Dr. Reddy's as well as Divi's Laboratory. Well, we have gone on for a goodish bit. Thanks so much, Gurmeet, for coming down to Bombay to our studio and, in fact, giving us all your views on the market. A little bit of consolidation will not be such bad news, and all those stocks as well that we spoke about. Remember, all our viewers out there, if you happen to see Gurmeet at the airport, Mumbai airport, it could be a good day actually for the stock market because as we just discussed at the start of the show, every time Gurmeet's in Mumbai, just for those few hours, but the market takes note of it, and we see a big rally. So thanks so much, Gurmeet.
Always a pleasure.
All right, on that note, we'll wrap up on the show then. You have a pleasant Monday evening and have a rocking week ahead.